What's going on, you guys? Shiraz Ahmed here. In today's video, we're going to be talking about investment psychology and, more importantly, what goes on in a person's brain when the market is pulling back and how, frankly, to avoid some of the most common mistakes that people make in the heat of the moment. So stay tuned. All right, welcome back, you guys. So again, today we're going to be talking about the psychology of investing. It's easy to stay calm and focused when everything is great. Sure, you might be a little bit jealous of that crazy return that your friend may have made flipping some crypto like Doge, but you probably won't get too bent out of shape about it. Now, the real test comes is when the markets stop cooperating. And you may have seen this or have felt this before, but when you're looking at a screen that's mostly red and wondering, where did I go wrong here? Now, your first knee-jerk reaction may be to say, you know what, forget all this noise, sell it all, and this actually might be the best strategy. But how do you make this decision? Well, I would ask you, what was your plan in the first place? Or frankly, did you even have one? Well, that's why you probably can't decide what to do. Now, this leads me to my first tip, which is make a trading journal. Before you make a trade, think about it. What is the plan here? Now, when we're talking about individual stocks, what's your strategy here? No one buys something with the expectation of losing money. But what if that actually ends up happening? Would you still hold it if the stock's value were to drop, let's say, by 20% the day after you bought it? Now, what if the stock would jump upwards 20% the following day? Would you sell it all and try to take a quick profit? Or try to ride that wave out a little bit longer to see how much more you can get? Well, ultimately, the whole idea behind this is write all of that down. When you see some movement on the price that way, you won't need to panic, because you've already got a plan. Go back to your notes. Why did you buy this stock, or what was your thesis in the first place? Now, are those reasons still valid or still intact today? Have things changed that would maybe influence your decision to either hold, sell, or maybe even buy more of the stock? Now, also, don't forget that you can actually preset trades to occur at specific prices, such as a limit order or even a stop loss. Maybe you might want to limit losses and decide that if it drops indeed by 20%, you may want to get out of it entirely and sell everything and cut your losses. Now, this for some people is a valid strategy. The problems start is when you haven't thought about these scenarios in advance. And then you're deciding in the heat of the moment, and emotions almost certainly will end up taking some influence. And that's usually not a good thing when it comes to making sound financial decisions. Now, after you've done this a few times, you can kind of go back and start to reflect on your outcome. What would you do differently next time? What mistakes did you make? Now, did you end up following what your written plan was? And more importantly, what was that result? The best tip that you'll ever have is to get a financial plan and invest according to that plan. Now, in my practice, the analogy that I've always told my clients is that investing without a plan is like trying to drive somewhere without a map or even GPS. The question I'll always ask you is, how do you know when you're there? Just like having a plan for individual trades, you need to have an overarching strategy that looks beyond the short-term things like those individual trades. Too many people invest aggressively when they don't necessarily need to, which can cause unnecessary stress over the markets. There are really only two reasons to invest aggressively, because you either A, need to, or B, because you want to. Without running some basic financial planning exercises or even projections, there's no real way to know if you even need to invest aggressively. Now, if I were to tell you that you could hit almost every one of your financial goals in a low-risk portfolio, would you still choose to seek out a higher return and potentially some higher risk? Well, we know for some people they would probably choose that option, but others would choose option B. Now, we know some people would choose the first option and seek that lower rate of return, but option B is also very appealing for some people. Of those people who decide to still try to earn that higher rate of return, you have to ask yourself, are you actually willing to take that risk? If you wake up one morning and see that your portfolio is down 20% and your first instinct is to sell everything, I hate to break it to you, but you might not be as willing as you think to accept risk. Now, if your first thought was, wow, everything is a sidewalk sale right now, maybe I should buy more, then perhaps more risk might be more suitable for you. Now, trust me, you'll save yourself a lot of stress down the road if you're frankly just honest with yourself and look yourself in the mirror on how really do I feel about risk. Now, imagine a specific example that you're trying to save for a house, and you want to purchase that house within the next 6 months. You might think, well, I'd like to earn as much as possible in that time so that I can buy an even bigger house. But what's the risk here? If the markets go down by 20% instead of up, now maybe you can't even buy the house at all. Now, is that a risk that you're willing or capable of taking? That's the question you really need to ask yourself. All right, so now you see some of the things that are important to be mindful of, and hopefully that can help you avoid some of these most common psychological tendencies that people have. Make sure, regardless of whatever you're trying to do, that you have a plan. Go back and revisit that plan regularly, whether that be just a complete plan or even something just as simple as the back of the napkin or just your trading journal. Consistency here is what's key. Now, of course, after all, as the saying goes, if you don't have a plan, then you're planning to fail. So hopefully this gives you guys some insight into the world of psychological investing or behavioral investment counseling. If you appreciate the content that I've been creating, please consider hitting that like and subscribe button, as it really does help the channel out. Also, if you hit the bell icon, you'll be notified the next time that I upload a piece. Until next time, please stay safe out there, you guys, and bye for now.